Okay, we're ready. So this panel is called The Future of Seed Investing. And on this panel, we have Shane Kelly from Wolverine Angels, Laura Deming, the Longevity Fund, Simone Sayed, Wolverine Capital, Edith Young from 500 Startups, and Chenua Farnsworth from Blue Startups. Please welcome our panel of Future of Seed Investing.
Good morning. My name is Shane Kelly. I'm with Wolverine Angels. I'm the founder, managing partner of Wolverine Angels. So we're kind of a hybrid venture fund angel group. And we're here to talk to you this morning about the future of seed stage investing. So to kick us off, I'd like to ask each of our panelists to just introduce yourself, introduce your fund, and then introduce kind of what got you into seed stage investing.
Start with me since you're looking at me. All right, my name is Edith Young. I am with 500 Startups, and particular focus on mobile investments. So I actually have a micro fund, $10 million mobile collective, and we invest. So 500 Startup, by the way, for those of you who may or may not know, 500 Startup is no longer 500 Startup. It's actually 1,200 startups. We've been around for about 5 years, and half of our investment is done through Accelerator. So right now we actually invest $125,000 for 5% of the company. And once you get accepted, you actually spend 4 months with us, with Accelerator, either in San Francisco or Mountain View. I particularly focus on things that's outside Accelerator, usually with companies that already launched, already have some customers. You don't necessarily have to make money yet, but definitely I need to play with the actual apps or tools if you're doing back-end.
All right, I'm Chenua Farnsworth. Aloha. I'm from Hawaii, and I run Blue Startups, which is a venture accelerator in Honolulu, and also Hawaii Angels, which is Hawaii's only angel group. I've been doing investing in Hawaii for the past 20 years. So I've had several micro funds, and now doing primarily Blue Startups, which is a venture accelerator. We are on our 6th cohort. We have now 50 companies in our portfolio.
Hi, I'm Laura Deming. I run a seed stage healthcare fund. We typically invest around $300,000 into early stage companies and therapeutics. Our focus is on aging, so you can ask more about that later. But we do invest kind of across these areas. So.
Hi, my name is Simone Sayed. I'm a founder and managing partner of Wolverine Capital. We're a seed stage fund focusing on industrial scale hardware technologies. Our typical check size for our new fund is about $250K to $1 million. And thank you for inviting us on this panel, by the way.
Thanks so much. So first of all, I'd like to just kind of set the stage in terms of seed stage investing. So why are we talking about seed stage investing here? And I'd like to open that up to the panelists. I'd like to get all of your thoughts on why you are actually investing in the seed stage, as opposed to, obviously there's now kind of pre-seed, there are what we call angel rounds, and then there are later stage, right? There are Series A funds, and then there are later stage funds than that, there are growth funds. Why have you chosen to invest at the seed stage?
Okay, fine. By the way, we should argue. That's what makes the panel interesting, right? So why? I can say for me personally, I think seed stage is so fun to do. I don't like to do anything that I don't enjoy. So, and working with founders so early on, particularly on mobile. Before joining 500, I actually worked on a company called Dolphin Browser. We've been around. Right now, I think I have 150 million installed. So my particular focus has been user acquisition and also partnership. So the type of help that, at least if you focus on consumer app, I actually love sitting with founders and chatting with them and thinking strategy of how to launch and how to grow. Those are really, really fun for us. But on behalf of 500, like one of the reasons, a big philosophy, which I'm sure that you guys have heard Dave talk about it many, many times, the cost of starting a startup is so much cheaper now. So unlike 20 years ago, you don't need to buy big server, and you can pretty much set up any, not for hardware, of course, and therapeutic is very different, but for software, particularly for mobile, over a weekend you can actually put together an app pretty easily. In a really, really short time, usually for pretty much like a month or two, you can figure out if this app is if you're a consumer, this actually will work or not. So our thesis is that if we invest early, even like 50K, 100K, in a few months we'll know if this is going to continue or not. And the bet that we're going to make is so much smaller than the Series A, Series B. And I think for let's say imagine if you were the last investor to invest in Box right before they go IPO, you actually will lose money. So think about that. So that's one of the reasons why we're really into seed stage.
Let me just interject here and do a quick poll of the audience. How many people in here are with startups? Raise your hand. How many investors do we have in the crowd? Okay, so for the startups, would you think of yourself as pre-seed? Okay, seed? Okay, great. And then later? Okay. So it looks like we're speaking to the right audience. So with that, I'd like to open it up in terms of, how you define, seed stage as an angel group, and then why you choose to kind of develop your accelerator for seed stage companies.
So I think, the angel group is moving kind of up the food chain, and the accelerator kind of comes in behind where angel groups used to be in the seed and pre-seed. So our angel group now, much like other angel groups in the country, really expects you'd already have traction, you post revenue, all of those things, which leaves that gap of prior to that, which then accelerators have filled in. So our ecosystem is very similar to that. Our accelerator comes in first in that pre-seed stage, and then the angels kind of take over from there. So it all works very nicely together in our community, which is very helpful. I've talked to many others where that doesn't quite work as well. So I think we're fortunate in that. And just to answer the previous question, I really enjoy it hands-on also. So that's really the reason why we've moved from, at least I've moved from being a kind of micro VC where we're just writing bigger checks and not getting as involved to being very hands-on. With the, even having the entrepreneurs in your space with you and all of that I find very invigorating. I love coming into the office with 30 people that are working on their projects and their companies. That's exciting to me. That's like a thrill. And they're also driven and intelligent, and I'm learning every day. So I find that very stimulating.
So now we have two folks who actually run more traditionally structured funds, but still investing at the seed stage. So why did you all choose to invest at the seed stage? Suma?
Thanks. That's a really interesting question. And so there was a really obvious gap in the capabilities of funding for the type of companies that I particularly look at. And so when we're looking at industrial innovation, you have your predominant early financing coming from non-dilutive funding resources like grants, and coming out of research laboratories and universities or R&D groups and large bureaucratic entrenched type companies. And what we kind of found out was that there was a gap between people who were retiring risk in these types of companies and where they could get their next tranche of funding. And so we aimed to fill that gap. And the reality of the way that venture funds work, we also find that you really get to achieve those outsized returns when you are investing early stage, seed stage, for us in particular. And so that just seemed to be a really, really awesome sweet spot for people like my partner and I.
Yeah, so I think the TLDR for us was, so our fund's actually a little bit different than most. We're focused on aging technologies, which means things will make you live forever. No, I'm kidding. It's probably not going to happen. But hypothetically speaking, some of our companies could make you live a little bit longer than normal, which would be awesome. And so kind of the focus of us was not let's make as much return as humanly possible, which I think actually would still have an overlap instead with where we are currently, but rather what is the most helpful way in which to interact with these companies? And that was obviously come in when nobody else would fund them, come and give them $1 million or something, enough to get them to the point where they could show data to a VC as opposed to just saying I have an idea, which in biotech means nothing. It's so different from tech. In biotech, you have an idea, it means nothing. If you have some data, it means everything. In preclinical, so you have enough to get maybe a 20 million round or something. If you get into the clinic and you show data, then you're golden. There's no way that you lose value from there. But so yeah, sorry, I think I got a little bit off topic. But the reason that we started was to help the entrepreneurs do better in their startups, and that was the seed.
So let me just take a quick poll of the panel now. What is, just a quick question, what do you think of as the kind of the typical size for a seed stage round of investment that you would typically invest in? Because I think this is something that varies across geographies and also based on sector. So I'd love to get a sense of how you think of the size of a seed stage round.
I mean, I guess I'll just start. I think 250 to $1 million is basically, that's where I would categorize seed in my mind.
I participate anywhere from 250 up to 3 million.
Let's see, because again of the type of companies that we're looking at and the fact that most of them have retired a lot of technical risk, for a seed stage in manufacturing automation type companies, we're looking at investing in rounds that are around 500 to 4 million, maybe 5 million. Looks good to us.
So I think in biotech it's a little bit different, or at least in the companies that we invest in, which is a different structure than most. We typically invest 300K in a kind of convertible note, or do some kind of small round, which then folds into a larger round about 20 to 30 million later on. So it's a big jump up, but I think given that you're running a clinical trial with humans and humans cost money, that's kind of why there's this big increase in round size.
I do want to add one thing, which a lot of times, a lot of back and forth between some of the founders we invested in. We usually will ask for at least 250,000 pro rata for the next round. That's because we invest so early, so we wanted to participate, and it's also a good signal for your downstream investor also.
So is everyone familiar with pro rata? Okay. So pro rata rights, and feel free to jump in here. So pro rata rights just essentially when we come in and invest, we want to preserve our right to follow on in the next round, so that we preserve kind of our ownership stake in the company. And so that's what we mean by pro rata. And Edith, that's actually a really important term for us too. So we look to get pro rata rights in the majority of our deals. It's just really important as a company grows that you have the ability to continue to support that company down the road. And so with that, I want to kind of dive into the topic of our panel here, which is the future, right? We're talking about what we're doing, we're talking about what we've done, but what's the future? I think each of you on the panel is kind of taking a pretty interesting approach that may raise some eyebrows among, traditional VCs, right? So, first of all, I'd like to get the thoughts of you, Shenhua and Edith, because you are investing as an accelerator, and then you're also investing independently of that, right? So, we have the influx of, Y Combinator and Techstars, and, I put 500 is up there in terms of kind of, there's a ranking of the top accelerator programs out there that was done by a couple academics, and it's pretty interesting. It's not perfect, but it's interesting. So I'd love to get your thoughts on kind of, as we have, really, the way I think about them as an investor is I actually think of an accelerator as a VC, right? Because they're taking an equity stake in your company, And I don't know if everyone perceives it that way outside of the venture investing industry, but that's how I think most of us think about it. So that is really kind of an innovation on the traditional venture capital model. So where do you see, the accelerator model going in the future? And what do you think, what has been your experience with it so far in terms of how you measure its success?
Well, I'll just start. I think the accelerator model is here to stay, although it is shifting somewhat, and it is an innovation on venture capital. So it is, as it kind of referred to, it's placing lots of small bets. That's kind of the basic concept behind it, and I think that will continue. One of the trends we see in the accelerator world, however, is that many accelerators now are launching seed stage funds too. Either follow-on funds or seed funds that kind of go hand in hand with their accelerator because of all these issues we just talked about with pro rata rights, etc. You need to be able to double down and continue to double down or you're not going to get the return that you need. So, we do have also a follow-on fund. That's really critical, we think, for the returns that we expect. And I think most accelerators are headed in that direction. So it will be interesting to see, again, as accelerators now move downstream, who comes in behind them to fill in that gap, that very early stage gap. Is it a different kind of accelerator, et cetera? Because I think the accelerators, for example, that are in that top 20 ranking, which we were one of, yay, will continue to move downstream a little bit as they can. They can attract more and more deals with more and more traction. I know 500 is definitely moving in that direction in a big way in terms of, they want their companies to have significant traction before they even come in. So we'll see what happens. Again, that early stage will need to be filled by someone.
I think for the future there's so many different angles, but no matter measure success, let's talk about that. I think the way internally we look at success is, of course, always counting on unicorn, cantors, and so right now we actually have 3 unicorns: Twilio, Grab Taxi, and Credit Karma. So these are the 3 that is above $1 billion in terms of valuation for us. And we have about 20, 25, 30 companies is 100 million plus, and then a whole lot of other which is below. And we know for a fact that 1/3 of our investment will die. It's just fact of life. It doesn't matter the size of the portfolio. It's just the law of investing. And so I think one of the big things, which since day one, particularly for Dave, is 500 is all about being global and international. And one of the big things that I can see in the future will be more vertical focused fund, more geo focused fund. We even starting even right before me, I think 3-4 years ago, we already have folks in India. Kylie joined us, I guess, out of Southeast Asia. We now have people in Thailand, Vietnam, Singapore, Kuala Lumpur, Tokyo, Korea, Israel, Russia, in Brazil, of course, where Benji is. All these sort of people, places, we want to be the first one to invest in the best entrepreneur in these countries because we're very bullish in emerging markets.
No, that's a really interesting point, I think. And I would argue that venture capital is traditionally geo-focused, right? But just now, in the last several years, as you're mentioning, we're seeing funds explore new territories, new areas that they haven't explored before, even setting about posts in those areas. And I think, there's the East Meets West, conference that Shenna was doing, which is really focused on kind of building a bridge between Asia and America. I want to direct the conversation, though, too, to something else you said, Edith, which is the sector focus. So, the last time I heard of a healthcare-focused seed stage fund or a manufacturing-focused seed stage fund, you all are really kind of innovating yourselves, right? So I'd love to hear your thoughts on why you chose those sectors. I know we have a very short amount of time left. We only have about a minute left, but I'd love to get your thoughts on that.
Okay, just mission focused for us. It was because I was interested in aging.
Because it's what I know. It's what I understand. I understand industrial innovation. I understand why we have become so entrenched in these kind of ridiculous sectors, or rather, why we're ridiculously entrenched in these sectors because of large corporations. And now we're at the point where we can actually manipulate atoms the way that we manipulate software, and so it is now time to have our type of fund.
It's great, and I think, from our point of view, one innovation that we're betting on is the idea that people will invest around an affinity that is not necessarily geographically focused. So all of our investors are University of Michigan alumni, and we've seen interest from, go blue, and we've seen interest from a number of other universities who are taking a similar approach. Duke is taking a really interesting approach around that. And I think Stanford has done some interesting things there. So with that, I just want to thank all of our panelists for joining us here today.
Thank you.
Yeah. Okay. So yes. Question.
So doesn't follow-on funding have to do an accelerator sort of a conflict of interest? Because if you don't invest in the company, then why is it relevant?
So the question was, if you have an accelerator and a follow-on fund, is there any conflict there when you're picking winners within your own accelerator and not choosing others?
I think there is, and you can't really avoid it. I think the bottom line is, this is the real world. It's Darwinian, and you have to just kind of live with the choices you made, and hopefully everybody acts like adults and they don't get, too hurt. But I certainly have entrepreneurs who have, not been happy with our decisions, but we're running a business, right? So that's how it goes.
Any other questions? We have one on the side here.
Hi, my name is Patricia, and I represent a population that's way bigger than an actual app or the mobile device itself, of the human being. And I'm really interested in talking to some of you medical women about seed money for education at the university level and vocation level. And I participate with Eastern California, taking that international.
So the question was, about seed stage money available for kind of helping human beings, I think with education and generally how do you support human beings there? And I think that may be a good question for Laura.
Like that, no, some health and well-being in the body as a result of evolved seeing.
Yeah, I think Laura can address that question.
And I was going to say this earlier, but everyone should read, this is kind of tangential, but everyone should read Brad Feld's Venture Deals if you haven't already, because if no one knows in this room what a pro rata is, to improve your health as a human, you should read this book. Yeah.
But I just wanted to comment one thing that she said, which is just to point out, this is an all-female panel, except for you, Shane, which we appreciate your moderation, but that's pretty awesome.
All right, great. Thank you for the questions and thank you to our panel.